Hello everyone, welcome back to my channel. In this video, I will show you proven intraday trading strategy for Nifty that you can add to your portfolio. So I will be covering the strategy details and detailed rules, and then I will show the couple of examples, and I will show detailed backtest results from 2015 to 2024, and finally my recommendations. Let's get into the strategy. This is an intraday trading strategy. It works on Nifty. I have backtested on the index spot price. It can trade in both long direction as well as short directions, and it works on 15 minutes time frame. The indicators we are going to use are true range, and next one is average true range, 50 for entry and 500 for SL, Heiken Ashi Close price, plus Bollinger band range. For Bollinger band, we are going to use length 75 with normal standard deviation of 2. Let's look at the buy rules. So the buy condition is simple. We are going to add true range indicator that you can find on the trading view, and then we are going to add average true range. The length is going to be 50 as we discussed before. The green line is true range and the red line is ATR. So as long as true range is below the ATR, we have our buy signal. For entry price calculations, we are going to use Heiken Ashi Close. For example, at 1 o'clock, Heiken Ashi Close price is 23916. Plus, we are going to use 0.2 times of Bollinger band range. So for Bollinger band, as we discussed, the length is going to be 75. We are going to calculate difference between high and low. At the same time, there is no direct indicator, but you can create a trading view script to calculate this range. Automatically, it will show the difference between upper band and lower band of Bollinger band. In this case, it is 687. That is our entry price. Once our entry price is triggered, then we will enter into the trade. If it is not triggered, then after 5 hours, we are going to delete that order, which is basically 75 minutes. Once we enter the trade, we place our stop loss with this formula, entry price minus 3 times of ATR. But here we are using length 500 to capture the long-term volatility. And if we don't hit the stop loss, finally we are going to square off at 315. Let's look at one of the example. This is at November 5th, 2024 at 1 o'clock. We can see the true range is below the ATR, so we have our buy signal. We are going to calculate the entry price. In this case, all the previous signals that are generated before 1 o'clock, they are deleted since there was no trade executed after the 5 hours. So in this case, at 1 o'clock, the Heiken Ashi close price is 23916. That is what we used here, plus 0.2 times of Bollinger band range, which is 687. So at this price, this is the upper band, which is 24426, and lower band, which is 233,739. So the difference is going to be 687. So once we apply this formula, we are getting our entry price as 24053. So as you can see, at 1 o'clock, we generated our buy signal and our entry price is 24053. This is where it is placed. And as you can see, at 1:30, our entry price is triggered. Once it is triggered, we calculate stop loss using this formula, which is nothing but our entry price minus 3 times of ATR of length 500. So once we know the stop loss, then we place the stop loss. Since in this trade, our stop loss did not hit, we exit our trade at 3:15 p.m. Our profit and loss will be 154 points. With the Nifty lot size of 75 quantity, it is approximately 11,550. But this profit will change based on how you trade. If it's a option buying or option selling or futures. So accordingly, your capital will change and your profit will change. So let's look at the sell rules. These are exactly opposite to the buy rules. We generate our sell signal if true range is more than ATR. Once our buy signal is generated, then we use Heiken Ashi Close minus 0.2. So in previous case it was plus, but now it is minus. So the stop loss price is going to be entry price plus 3 times of ATR. So earlier it was minus, now it is plus. If it is not hit, then we exit our trade at 315. So in this case, our sell signal generated at 10:30. This is our entry price based on this calculation, and it got triggered immediately next candle. And this is our stop loss, but it was not hit throughout the day, and then we exit our trade at 315. So some rules for this strategy. So you can only have maximum 3 trades in a day and no entry before 9:30 and after 3 o'clock. And if you are already in trade, you should not take another trade. For example, even if you are in buy trade, you should not take sell trade. So at max 1 trade at any point of time. So let's see the backtest results. So for backtest, I have done it in Python and the trade history is exported. I have included all charges, including brokerage, STT, SEBI charges, all of that. And brokerage is 20 rupees per order. I have considered slippage also as 0.1%. So this is how the equity curve looks like from January 2015 to November 2024. So this is almost over 10 years of data. As you can see, it is going upwards. I have considered 2.5 lakh for one lot. and average yearly returns are 47% with maximum drawdown of 21%. So drawdown is nothing but at any point of time what is the amount that we can lose, and the ratio between returns and drawdown is 47/21, which is 2.17. Ideally above 1 is very good, so this strategy is good. As I mentioned, I have considered slippages, brokerage, all charges. So if you can see from 2015 to 2024, all years it is profitable, with 2017 being least returns with 13% and 2024 being 99%. Monthly wise, we saw continuously 4 months we were in loss, so you should trade this strategy even if you hit 4 months loss. But at the same time in 2016, all 12 months profitable. So as part of systematic trading, this is part of the trading journey. Important one is the Sharpe ratio. If you know, it is 2.25, so this is also good. R square 0.97 is pretty good. So risk reward ratio is 1.4, but win rate is 51%, and the expectancy is 0.3%. Means on an average per day you make 0.3% with this strategy, and in a month on an average you make 3.9% return. So from backtest we saw drawdown was 21%, but Monte Carlo shows us the random probability of drawdown reaching 43% with 95% confidence. So we should ideally stop trading this strategy if we hit this 43% in our live trading. So if you consider charges, the return dropped from 63% to 47%. So that's why it is very important to consider charges in backtest along with slippage. So the ratio dropped from 3.31 to 2.17. So let's look at the summary. So this is the equity curve, which is going pretty smooth with the average yearly returns of 47%, and drawdown is just 21%, and return to drawdown ratio is 2.17. The win rate of this strategy is 51%, and the risk reward is 1.4. This is a pretty good combination of win rate and risk reward. Since you cannot trade this on spot price, you have to trade futures. So futures will be as close as to this backtest. As I always say, you can reduce this drawdown if you trade more than one strategy. So don't depend on one strategy alone. You should always remember that like any trading strategy, this is one more trading strategy. So you should always test it before you take it live. So do paper test, and once you get confident, then only you take it live. Also, don't depend on single strategy. You should trade pool of strategies, so that if one strategy goes in drawdown, then another strategy will make money. So that way by end of the year you will still be profitable. Alright, that's it from this video. Happy trading. See you next time.